Hey everyone, I am really excited for today's guest. I have been quoting some of Jenny's work now for probably 8+ years, ever since her time at Techstars. But Jenny Fielding is going to be sharing a lot on the fundraising process with us today. That's a lot of the work I've quoted of hers. She is the co-founder and managing partner of Everywhere Ventures, where they have been the first money into over 300 companies now. She's also an author of Venture Everywhere. And prior to this was the managing director at Techstars. Jenny, welcome. Thanks for coming by. And I guess first and foremost, like why everywhere? Where did everywhere come from?
Well, thanks for having me. Super excited to chat with you. Well, there's, this funny thing about me getting on a plane. And so, you mentioned Techstars, so I'll kind of tell the story, which is, at some point it became harder and harder to run an accelerator in New York City because there were tons of programs, there was tons of money. And so, different managing directors and different people at different accelerators had different ways of dealing with that. And not being in the Bay Area, I just thought, well, I can hop on a plane. And so I used a significant amount of my budget to go to far-flung places and to meet founders there. And so, one of the things that people would always say to, about me was like, oh, Jenny, you're everywhere. Like you're in Mexico City. Like I just saw you were in Kenya. And so, yeah, I just really, tried to tap into entrepreneurial communities in places that a lot of the other folks, especially Bay Area investors, weren't going. So I was just never scared to kind of go into new geographies. And it was great at Techstars because we had a program called Startup Weekend, which you might have heard of. And there were startup
Mm-hmm.
weekends run, I mean, in every single country. Like they literally run in crazy places. And wherever I showed up, there was like this kind of extended family there. And, they were just so excited, to have someone from Techstars there. And we'd always host events. And so I just got to know lots of folks around the world. So when I launched my own fund, it seemed like this was a good, representation, I guess, of me and the way I saw the world. So long answer, but very near and dear to my heart.
That's amazing. I have a couple follow-up questions just from that.
Yeah.
So it sounds like getting on a plane and just meeting people in person was a competitive advantage to yours early on. Is that still part of like everywhere? Like you're still getting on a plane? Because I feel like you have such a big brand following now that like maybe deals and things can come your way. Like how has it shifted at all?
I mean, it's for deal purposes, but it's also for perspective. I mean, I think that when you go to these other ecosystems and you just, listen a lot and meet people, like your perspective changes, both on the way that you view entrepreneurship, but then even very specifically on like, oh, well, what are people in Africa interested in? And what are the new technologies that are going to be developed, based on the needs of businesses in LATAM, right? And so you don't really gain those insights as much from reading about them secondhand, but when you're there, you really feel the pull of it. And it just kind of like it makes more sense, if that makes sense. So I have a chapter in my book that opens with me getting, flying into Mexico City, I mean, probably more than 10 years ago, and getting picked up in a car and asking, the guy that picked me up, who is actually a Startup Weekend guy, oh, like it was a Mini Cooper, which is what I had in the US. And I was like, I'm in Mexico. Where'd you get this Mini? And he's like, oh, there's this like incredible new used car marketplace here. And he started telling me about that. And, they were a very early kind of, call it Carvana for LATAM. And now they're like the leading, I mean, I think they last raised money at like a $9 billion. I mean, it was like a startup back then. And now it's like, the biggest. And so you kind of hear about these gems really early on. And I was really lucky to interview one of the founders of that company for my book. And, I told Lori the story of like, oh, how I knew about her company was that someone picked me up in a car that was just like mine and we were in Mexico. So, I think you can get these insights by, kind of just opening your eyes in other locations that are relevant to, our investing philosophy and also our investing thesis, which is innovations everywhere. We want to be where the best founders are, wherever they are.
Yeah, amazing. How did COVID change any of your perspective when there was a lockdown and you couldn't travel as much and get to some of these locations? How did that play out?
Yeah. I mean, I guess the one thing I'd like to preface this on is this isn't about like meeting people in person to have to invest. So that's like something
Mm.
a little bit nuanced and different. We invest meeting people over Zoom all the time. And that started way before COVID. We built this firm async from day one, which was like very unusual, where we didn't have like an in-person Monday meeting and we didn't have to meet founders in person. So my, travel kind of goes back before my venture career, but it's really more about, interacting with different ecosystems, hopefully tapping into them and maybe being a small part of them. Sure, everything snowballed during COVID. And I think then the world kind of caught up to, oh, you can forge relationships, you can invest, you can do a lot of things without meeting people in person. And so, yeah, COVID was tough for me, but somehow I managed to still travel the world during COVID and not get COVID.
Fantastic.
I know.
I'm going to shift to fundraising and building a fundraising process. I have a slide that I share with founders a lot with some of the work you've done in the past, which is like 95% of founders don't even have a process. I think it's so key just to running a startup in general, especially for raising money. So just to kick things off, there's this adage of like, should founders always be raising or never be raising? So I guess the question is like, should founders always be raising?
The answer is both. So, founders always have to be ready to capitalize their company. Does that mean that they should always be raising money? That's going to be very specific to their situation, to where things are. And the reason that, I don't want to conflate those is there is a kind of a founder persona, even if things are not working, they haven't found product market fit, that they're still raising, right? Because they're trained to it, because they feel like that's the only way to keep on going. And that I don't think necessarily is good or fruitful or the right way. But this idea of always being kind of ready at any drop of the hat, and COVID, since you mentioned, is a great example. I mean, we had companies that all of a sudden were kind of left in the lurch and they had to figure out like, what am I going to do to keep this company afloat? And, some of it was not about raising, but sometimes it was like, oh, maybe I need to do a quick bridge round, or maybe, I need to get something together. So I think the founder mindset and the investor mindset is that you always have to, be ready to capitalize your company.
Getting a little bit more specific, what about like, even if I'm not raising capital, taking investor meetings, like, do you have an opinion there? Like, hey, I should always just be meeting with investors and if they're reaching out, like keeping them up to date, or should I only be meeting with investors once I'm actually decided that like, boom, I'm now going to start a fundraising process?
Yeah. Well, I think, when you're raising, that should be a very clear and defined period of time. And you should make that clear to everyone that you're speaking to. I am not fundraising, I will be fundraising, or I am fundraising, which are really your only states of play, right? And I think the reason that, you should have these delineations is because a lot of times founders are not raising and they're kind of having casual conversations, but then they get pulled into a process. And that is oftentimes, a waste of time, or it's not what they wanted. So I think as the founder, you need to be in control. And what that means is like, okay, I'm fundraising or I'm not fundraising. If you're not fundraising, to your question, what should you be doing? And I think it's, healthy to spend 5% of your time meeting investors. That is very different from taking inbound from random people, random investors. And I think, again, there's some nuance there. So you should always kind of have a target list of who would be kind of your top 20 or 40 people on your cap table. Cultivating relationship with them or staying top of mind, I think, is a good thing. But, randomly getting on a call with junior people at large funds, I don't necessarily recommend. You can get pulled into things that you don't want. You can share information that you don't necessarily want. And all that information, gets put into someone else's CRM, and you don't necessarily, want that, and you can't necessarily control it. So I think just be very smart. And if these are decision makers at a firm who have a thesis around something that you're building, sure, cultivating a relationship with them, spending 20 minutes on a call or grabbing a 30-minute coffee when you're in their city makes a lot of sense. But otherwise, I think just focusing on the business.
Yeah, I love that. When I do decide that I'm going to raise, like how far in advance should I start prepping? And what is, like, you mentioned being ready, like, what does being ready look like to you, both, I guess, maybe emotionally and tactically?
Yeah. Well, I think if it's like your very, very first raise versus, a second or third raise, maybe the answer is slightly different because, if you're raising a seed and you've already done a pre-seed or you're raising a series A, I think, hopefully you have lists built, you have, knowledge of who's interested, but maybe you're a little too early and you've been cultivating that list. You've been sending, maybe quarterly updates is what I kind of recommend to, or at least every 6 months, to people that were interested and said, genuinely said, keep me posted, as opposed to like, you're too early, keep me posted. And that was just a blow off or we're not interested. Founder, you need to decipher which of those buckets you fill in. But there's a lot of folks that are genuinely interested to stay in touch. And I think that can be a great mechanism because then when you are ready to hit the trigger of like, hey, we're raising, those people are prime. They kind of know a lot about you. They've been following along kind of your ups and downs and seeing the momentum in the business, hopefully. If you're going out to raise for your first time, then, the process looks a little bit different. And you're probably going to need a couple months, I'd say, like 2 months is probably sufficient to, get all of your information, get your data room really tight, to make sure that you have references ready to go, that you have, everything that you would have in a data room, even if you never end up sharing a data room. And so that's we can talk about is like, I don't recommend that you kind of have this data room that you send. I recommend that you have the data room so that, you have everything ready to go because you will be asked for different elements in the data room. So that takes a while. And then really the investor pipeline, which I write and talk and yell about so much, which is really kind of creating a really good kind of CRM level researched pipeline of potential investors and figuring out a way to run a process like a sales process, which will be different for every person and every firm or every company. But whatever your mechanism is for getting people through a funnel, staying in touch with them and showing urgency, through communication and follow-ups and all of that, kind of, the machine has to be ready to go when you're ready. And so the research on that can take a couple of weeks. So I think if you give yourself like 6 weeks to prep, you're in really good shape.
Okay. Since you mentioned data room, this is a question further down in my list here, but since it's kind of relevant to this talking point, you've talked about having a push button data room.
Yeah.
So what does that look like in practice? Like you mentioned, maybe, hey, maybe I'm never actually sharing this data room. So like, what does that look like? And like, maybe what are some things Jenny cares about? Because you're investing in founders at an early stage. Like, what do you care about? Like, what do you even ask a founder to see in maybe not their entire data room, but like parts you might expect?
Yeah. Well, that is the thing. Every investor is going to ask something different. I'm sure you're going to ask for different documents or things than I'm going to ask for. Many founders and other investors are surprised that on my first call, it could be a 20-minute call, I ask a founder for a demo. People are like, oh my God, I raised my whole round and no one asked me for a demo. So every investor, and like, that's genuine. A lot of folks just at the pre-seed don't care about that, or that's not their focus. They have other things that they're interested in. So everyone's going to have different things that they're interested in. And that's why having all of them ready to go is really important. So, one thing that I really recommend is everyone has like a Q&A doc. So just a very simple, Google Doc with all the questions that you're being asked that were not the basic questions that you're going to be asked. Because every call that you get off or every meeting that you have with an investor, they're going to ask something that maybe you didn't think of. And you want to make sure that you have just like a totally airtight answer and that you're not fumbling or thinking about it or saying, oh, I need to talk to my CFO about that or whatever. And so I find if you write them all down on a list, that list will grow and grow and grow, and you'll keep that list for your next fundraise. And they're great, not necessarily to like add to your data room, although you can. I think that that's helpful. It's like, here are all the things you didn't ask me during the call, but you can,
Yeah.
but also just for you to get, super, slick at really putting your best foot forward of the answer that you want. Okay. So data room is going to have, all the basic stuff that people are asking you for plus more, but data rooms are where deals go to die. So what do I mean? And why am I putting it together if that's where my deal is going to die? So the truth is, like, when you send a data room, like, you've lost all leverage that you have with the investor, to kind of tease out the momentum or the interest in the, in the deal. And so what you want to do instead is kind of drip them the information. So you have the first call and like, oh, Mike, this was super interesting. Can you send me your deck? I only saw the blurb. And so like, great. Then you send the deck. And then we have our next call. And I'm like, oh, that was good. Thanks for showing me the demo. Like, do you have like a Loom video or something that like I could walk through or my team could actually look? So then you send that, you know, Mike, I'm like interested in your model. Can you send me your financials? Definitely not. Get on a 15-minute call with me, walk me through how, what the levers are in my operating model, how I'm thinking about unit economics. All these things, you can just send them one by one, but you don't want days to go by while you're trying to put a model together or while you're making the Loom video of your demo. So if you have it all in the data room, actually like maybe right before, we've shook hands, we want to be partners, eventually I might say, can you just send the whole data room so I have it all once? And then, you want to send it. So it's not about putting friction in the relationship. It's about kind of always having something to go back to and keeping the investor engaged through the process.
Yeah, I love that idea. We call it like progressive disclosure. Same idea, right? It's just like I'm kind of slowly disclosing things over time. What are other like effective ways to maintain that momentum through the deal making process and keeping things warm? So one of them is sounds like kind of the progressive disclosure. Any other good tactical things to share with founders? Like one thing I've always heard is like keeping a good piece of news part out of the deal, right? So like 2 weeks later, you can follow up and be like, hey, we see XYZ, even though you've already signed XYZ. Like any other good tactical tidbits?
Yeah. I think the worst email that I receive all the time is, hey, Jenny, just following up, see what next steps are. And it's kind of a soul sucking email to get because, it's hard to know how to respond to that. Because the truth is, like, if I didn't follow up, maybe I'm not that interested. And so it doesn't mean the deal is done. It means you need to, like, keep me interested. So how do you do that? Right. So it's like, hey, Jenny, just following up. I thought we had a really good call, wanted to tell you about this customer we just closed and how that really, helps solidify our product market fit or whatever that is. Or we just closed another 100K. In our case, it's small rounds. And so oftentimes they're very collaborative. Angels, small microfunds are coming on. And so keeping me updated on that is also another way of showing good news. So you never want to send the, just following up, just following up. I hate the dating analogies, but I mean, it is a dating analogy. Right? But just imagine that person just being like, hey, I'm just like following up, just following up. It's like, no, you've got to make something that seems much more interesting and enticing. And there's only, two things that get an investor to move. And that is, momentum in your business or momentum in the round. So those are your two talking points.
Okay. I love it. Getting into some of the concepts of like pitching and the pitch deck, what's your advice for founders refining their pitch? Should I workshop it with my peers, test it with like friendly investors? Should I jump right in to some investor meetings, maybe not my top tier ones, but ones that are like on my short list? Like how should I think about refining my actual pitch?
Yeah, I don't recommend practicing your pitch with any investors unless they're like, someone you went to college with and adore and they do Series B, drone deals and you're a healthcare company, right? So, but, talking through your story as much as possible to see whether it resonates with anyone else, particularly founders, other founders, mentors that you have, people that see a lot of pitches is also good. I think the problem with pitching kind of what we'll call an unqualified person, which is someone that just wants to be helpful, right? You're someone out of, at a law firm or, someone that's just not seeing so many pitches in this stage and understanding like the nuance of what people expect today. And also understand that changes. Like the expectation of what we, of what we expect today was actually different than a year ago, right? And that's in terms of the substance, but also just in terms of the presentation, right? Things change. So an example of that is like a couple of years ago, you never saw like a memo, right? So it was a deck, but you never saw this like memo on Notion or something. And now you see that quite a bit. And like that can be fine, but you need to practice with people that kind of are in the industry and they're kind of keeping tabs on what folks are interested in and how they want the information presented. But yeah, practice as much as you can. And then you'll get feedback. So I think to your point, you don't necessarily want to pitch your tier one favorite in week one because you're going to get a lot of feedback. That feedback is gold. All the questions that those folks asked that you stumbled on, you're going to put in your QA doc. And then, quite frankly, you're just going to get, if you're lucky, you're going to get like real feedback. If you're not lucky, you're just going to get facial expression. And sometimes those are also good, right? So if you're lucky, someone's going to say, and I always do this, like, to my detriment maybe, but, if it's a really terrible pitch, I'll just, sometimes stop and be like, hey, like, I just want to give you some feedback on this. And I think, founders really appreciate it. A lot of investors don't want to do it because there's really like no benefit to them. And sometimes the founder can get upset. So I understand why people don't do that. But you can kind of see like when people are tuning out, if you think they're taking notes, they're not, they're checking their email. So, you can kind of see what's resonating, what's not. And the good part is you can see what really gets people excited, right? And, oftentimes like I'm on a pitch and I get super excited when someone's saying something like, my voice gets louder or I get very expressive and like you can feel that, right? So that's another good thing for, you to note as a founder. So yeah, you want to pitch as much as you can and you'll just get better and better.
You kind of mentioned this as part of your process. I'm curious here, like you want to see a demo from an early stage company that's atypical. It sounds like maybe because the product changes or what have you. But what is that? What is that signaling to you? Like, why are you asking for a demo in the first meeting?
Yeah, I mean, I have a bias for investing in builders, and so I think now in the age of AI and vibe coding and the like, everyone's a builder, right? I don't think there's any excuses anymore. I mean, I coded up like a little bot myself. And it's like, if I can do it, anyone can do it. Right. So I think that, in this day and age, everyone has to be able to, show, not just tell. And sometimes the demo could just be, Figma drawings, or it could be something very raw. I'm not looking, at the GitHub repo, but it's really more to give me a flavor that like, something's been produced.
Hmm.
Yeah,
Yeah.
I think apparently it's a little unusual on a first call, I've been told, but I love it. Like I'll say to the founder, hey, would you mind giving me a demo? And all of a sudden they're kind of scrambling. And I think that's like really magical too, because like I just love when the founder is like, yeah, no problem. Just give me 2 seconds. And then they like pull something up and, it's really janky and they're logging in with their personal emails and all this stuff. And then it's like you see the magic. So I love that whole process of seeing, everyone's a little different.
What about pre-revenue companies outside of maybe the product itself? Like any other signals you're looking for when you open up the data room or requesting for something that's pre-revenue versus company producing regular revenue?
I mean, all the companies that we invest in are pre-revenue. I think, the things that we're looking for are, a founder who has a vision about a feature that doesn't necessarily exist. So we'll ask, if we're doing a vertical AI company, we'll ask like, okay, so talk to me when, SaaS is dead and what's your company going to look like? And the founder's like, oh my goodness. And so then I'm like, no, not in 1 year or 2 years. Like, tell me in 5 or 10 years, what the company is going to look like. So that's maybe a more unusual question, but that's the thing that I'm looking for is being able to navigate what's happening right now. Funny enough, I ran into one of the founders that I backed at the pre-seed, who's now past Series B on the street today. And she was telling me just how they had to completely overhaul it. It's a SaaS company and they had to completely overhaul their whole kind of C-suite and the way that they're thinking about it because, they're prepared and they're, already seeing all these like, AI companies with, you know,
Hmm.
2 guys and a dog kind of like sprint really quickly with a different business model. And what I loved about our conversation, just like randomly on the street this morning, was she was she didn't know it was coming before, but she was so prepared in the moment. And when I think back about why I invested in her, I just love that she could like make very quick decisions on like a small amount of data that led to like a larger hypothesis of where she saw the world was going. So she was very much focused on like where she thought, but then she looked at the data in front of her and reacted to that. So that was exactly what she did. She like had to fire half of her C-suite, rebuild, hire a very different profile. And she said like they're going to crush this quarter. So I mean, that's really what we are looking for, agile people who, whatever that person tells me of what's going to happen in 5 to 10 years is not going to happen, right? And that's not the exercise. The exercise is envision where you think the world's going, and then how are you going to get there? Because that is going to change like every couple of years. There's going to be seismic shifts, new technologies, whatever it is. And you have to be sure in yourself that you're going to be able to navigate that. And I've also seen the other side. I've seen founders who just paralyzed to make decisions, to change, to pivot, do things, and it's too late, right?
Kind of pulling on that thread a little bit, like what separates the founders who fundraise effectively versus ones who struggle? You mentioned, you've talked to people mid-pitch and say, hey, I'm going to give you some feedback. What are the common themes you see of founders that are really strong versus ones that need help? Is it, product traction, storytelling, their network, how they're just managing the process itself? Like where are some commonalities between those who do very well versus ones who struggle?
Yeah. I mean, storytelling is tough. And if you're not good at that, it is a much harder journey. So I think as a founder, you have to be good about telling your story. And hopefully it's not a burden. Hopefully it's really fun to talk about your story, because oftentimes it's your origin story. And again, where the future is going. And so if you can kind of light up a room with that, it doesn't really matter that you're not, super charismatic, or you're not, super extroverted, or, all these things. Like it's about the narrative of the story. And I think it's something that founders need to learn and embrace, instead of being like, oh, I hate fundraising. I hate, having to be the salesperson, the salesy type. And then I always tell them, like, I'm an extreme introvert. I am an only child. I'd much rather be by myself at most periods of the day. But I have a very extroverted job, and I've learned to be an extrovert, and I speak on at podcasts and on conferences like pretty much every day. And you get really comfortable with it, and you practice. And it's not about what your natural inclinations are. It's about, the skill that you've learned to develop. So I think anyone can become a good storyteller, but it's tough if you're not naturally inclined that way. So I think it just comes down to practice. But it really does help. Usually when I stop a founder, this is going to sound a little bit harsh. It's because they ramble and they're like really in the weeds. Those are like the two things, right? So we're on a call and they're just talking and talking and talking and rambling. They're not coming up for air. And it's not that they're, there's any maltenure, they're self-centered or whatever. It's like mostly because they're nervous, right? And so that's just something that you practice, like how to be concise. You memorize more of a script if you need to, and then it becomes natural. If that's, if you're someone that doesn't speak in. Yeah, I mean that's the big ones that see. I think that's usually why I stop folks. I'm like, wait, and then getting into the weeds, right? Super smart people. Many young people have been programmed early on. The more you say, the more in depth you are, the smarter you sound, and you need to deprogram yourself from that. The less you say, the more kind of tight and concise you can be, and the more high level you can be. And I think that's really hard, because many people think that that's just surface level, or like, won't they think I'm dumb, or that I'm not, I don't understand. It's like, no, we're just meeting each other. We need to learn how to, have cocktail hour talk, not, in-depth conversation. There will be lots of time for that. But in the first couple of meetings, your only job is to get me excited. And I'm not going to be excited if you're talking above me, like in things I cannot understand. If you're going so deep into minutia. And, if you're just kind of rambling endlessly where I can't like ask questions or get a word in. So I'd say those are the things.
Okay. That's super helpful. I want to touch on, as we can wrap up here, going now from the pre-seed seed stage to Series A. I think you had a quote along the lines of every seed investor's dilemma. All my Series A friends want to beat my early companies. All my companies are too early for my Series A friends. So like, how do Series A rounds rely more on like, do they rely more around like pre-existing relationships and like how far advanced should I like be nurturing these conversations versus, like a pre-seed seed type round?
Yeah. I mean, the good thing about Series A is that many of the investors, I would say most of the good Series A investors, they write a lot or they talk a lot. There's a lot of information about them and what they're looking for. So you can kind of almost like self-match a little bit easier than seed. Seed, there's like gazillion, pre-seed and seed, there's a gazillion generalists. And you need to cast a really wide net. I think with Series A, now that Series A's are like pretty late stage at this point, like you pretty much have product market fit, and you're going to have at least 1 million, sometimes 3 million in 3 to 5 million in ARR, like to get a real seed round done. So we're talking like 10 to 20 million dollars. So with that, there's probably like a good cohort of folks that you've already identified or you should identify that are kind of like your target, not just like, oh, some random partner and Andreessen because I want Andreessen on my cap table. It's like, oh, this person is actually speaking about my thesis, because unlike pre-seed and seed investors, like we're not thesis driven, although there are some early stage investors that are. All Series A investors are thesis driven, which means that they're looking for something very specific. And so you can find out what they're looking for just by, doing some online stalking of all the stuff they're writing about, all the stuff they're talking about. So that research is a little bit easier. And so I think cultivating relationships with those people early, again, not spending a lot of time with them when not raising, but having them on the radar, sending them a note every once in a while if you see something relevant or something like that, can be a really effective strategy.
Well, you mentioned the Series A is getting a little bit later and that you're starting to have like real metrics at this point. So how should I balance like my story? Like, how are you treating your files? Like balancing the story, but with like actual real evidence of like traction and growth. How does that change from, my early stage rounds to call it a Series A?
Yeah, I mean, Series A is not about storytelling anymore. While you still always need to be a good communicator and someone that can convey information effectively, it's really about, metrics. So I always say, like, you can sell the vision, once. Sometimes if I squint, I see founders selling vision twice, meaning no metrics. So like pre-seed and seed, it's definitely hard. By seed, like people really want to see some metrics, but by Series A, that's like the thing that they need to see. So it's metrics, it's unit economics, it's something like a real like financial model that works where you've really thought about all the levers and you've pressure tested all of that. Having a product that people love, you're going to have a lot of customer reference calls at a Series A. If someone's writing a $10 million check, you should expect that. So it's very, very different at the A. Those folks still like to say they're early stage. I mean, they are in that the risk is still quite high. And, even if you have found early product market fit, there's so many factors that can factor in. So they are early, but they're not, they're not pre-seed or seed. And oftentimes a Series A is happening, 4 years after a pre-seed. So there's been a while to really get your story down, your storytelling and your narrative, but that really won't be the focus.
What So data is clearly important. What kind of data should I be able to speak to cold, like in a Series A meeting without having to like look up anything or get back to you when I talk to my CFO? Like what should I know the ins and outs on?
I mean, I think it depends what kind of company, right? So, if you're a consumer company and you don't know like your CAC ratio and your payback and all of that, and you need to look that up. And sometimes I do find that when I talk to some founders, I'm like, no, you need to know those numbers, Cole. So it all depends on your model. But I think any CEO who doesn't know their numbers, I mean, I just don't even understand it. Like you should, by seed, be looking at your numbers like pretty much every day. So there might be some like esoteric analysis that an investor wants you to, to run, and that's perfectly normal. But I mean, I think the top line metrics that you should be, tracking kind of as your KPIs or really key metrics, I think you just need to know. And again, it'll change
Yeah.
if it's consumer, if it's a marketplace, obviously that's going to be really different than if it's a turnkey SaaS.
Hmm. Kind of last question on Series A, and then we'll wrap with one final question. Like demand continues to rise for Series A rounds. The success metrics are higher probably than they have ever been. How are you coaching founders that you've worked with that may never meet those demands, but like have a really great business, like a healthy business, but maybe I'm just not meeting the ARR growth rates that a Series A investor might expect? Like, how are you helping navigate that world for those founders?
I mean, it's tough, but I think for any round, you need to have a plan B. And, your plan B is that you're not able to raise the Series A. And so what happens? And then you have a very kind of fundamental choice. Do you want to get to, cash flow break even? And, either wait out a bad market, which I think, many people have tried to do the last couple of years. Maybe there's a, technological, turning point that might happen. Maybe there's a pivot in your future. Maybe you're just going to outlast everyone else in your category and do some M&A, like who knows? But that's like a philosophical, I think, decision for a founder to make. Like, what's my opportunity cost of doing that? Because if you don't have the metrics, you're going to be kind of left. And like, there just isn't frothy cash right now. So no one's going to fund you just because they couldn't get into, their first choice, their second choice, their third choice. So they'll do their fourth, which during frothy times, investors do. They need to put money to work and their LPs expect it. And they're like, well, I couldn't get into, the best company. So I'll take someone down the rank in terms of metrics. So that's not going to happen. So you just need to think of like what your options are and what your personal ambition. Many founders during this kind of last downturn, which, lasted or is lasting quite a long time, said like, okay, I'm going to get to break even. I'm going to control my own destiny. If the right investor happens to come my way, maybe that looks different. Maybe it looks like a family office, or maybe there's a private equity, or maybe there's, something interesting. And we have a few companies and we don't, necessarily give up on them if they haven't given up on themselves. And I think there are a couple of examples out there of companies that maybe raised a small amount, kind of bootstrapped for many, many years, somehow hit an inflection point, based on a confluence of, timing, market, the world, and became like a leader there. They're not like a huge number of examples. So I think it just depends on, does the founder want to run that type of company, or are they set on running a high growth company, at which point, they need to make some hard decisions.
I lied. One last question before my last question is now. So we're recording this the day after Labor Day. Is now until Thanksgiving like the hottest fundraising time? Like, should I, probably too late now based on what we kind of talked about earlier to get the process ready, but maybe for next year, like is now the hot time to like, does that exist? Like seasonality?
Yes. And it's not too late. Get out there if you need to fundraise. Yes. I mean, it's the craziest thing. And I don't know why investors like get out there publicly and are like, no, we're investing all the time. It's like, no, you're not. You're investing September, October, November until Thanksgiving, and then you're not. And you're not investing over the summer. Sure, deals close and sure, stuff happens, but this is a really good time to fundraise. So hopefully you've done some pre-work and you're raring to go. But the calls I hate to get are from founders in our portfolio, kind of the second week of October, being like, hey, thinking we're just going to charge ahead and raise before the end of the year. And I'm like, you're just going to be so hard, right? Because, you only have a couple weeks to do this before the world shuts down. And again, it's not that like VCs aren't working. It's just that like, there's a lot, we're not just investing. We have a lot of like deal process, helping our other companies, all this other stuff. And so it definitely comes in season. So this is a great time to be out there after summer. People are just really riled up. I think it's a good moment in time, a lot of anticipation that interest rates will be cut a little bit, and that, hopefully some of the, the turmoil with kind of tariffs and other things have like calmed down, and that people are, excited for a very productive and fruitful fall. So I think it's a good time.
Heck yeah. They got me excited. Last question. We actually started this with talking about yourself and everywhere and how much relationships have really changed and helped shape everywhere. What's one professional relationship that's changed your life?
There's my plug. You should read my book.
There we go. We'll share it for sure.
I mean, the thing that, so my book is like 12 chapters, 12 countries, 12 founders that have, changed the world in their geography and their ecosystem. And, really the people that inspired me and motivated me and made me a great investor is not one person, but it was all my peer investors, which people are, sometimes shocked to hear, but like those are the people I learned from. I didn't like grow up through venture. I was like many an entrepreneur, and I had to learn, by jumping in. So I learned a ton from my peer investors at Techstars and, all the other pre-seed investors that I just, admire so much. And those are the people that kind of inspired the book and inspired me and taught me venture.
I love it. Jerry, thanks so much for spending your Tuesday with us after Labor Day. I really appreciate all the insights that you shared with founders throughout the last decade, and I'm sure with the decade to come. So thanks so much for joining us, and we'll see you out there on the street.
Thanks, Mike. This was so fun.
Awesome. Thank you.